So, good morning, everyone. I believe you're well today. My name is Timothy Kiari, those that we are interacting for the first time, maybe. And on behalf of Scope Markets Kenya, I welcome you to today's webinar. And today we are going to talk about, or in this webinar, this is where we talk about the Forex intermediate class, okay? So in this class, we begin looking at the price action, or maybe what leads us to technical analysis. So we'll begin by looking at the different ways or different strategies that you can be able to look at the market with in terms of trying to identify your entries. Okay, so I'll be showing you how to analyze the market in terms of trying to get an entry. Also, shall discuss about the different candlesticks patterns that are very important in terms of trading, because you find candlesticks themselves, they speak volumes. They can be able to give you entries. They also give you exit points, okay, depending on the type of patterns they form. So it is very crucial, it is very important for you to understand them, because they'll form a very or they'll help you in terms of improving your trading. Okay, so this class is an advancement of what we did on Monday, that is the Forex basics. So on Monday, we laid the foundation in terms of Forex. We looked at what is Forex trading, the characteristics of Forex trading, everything in the foundational levels. I showed you how to calculate pips. I showed you the aspect of how you need to look at leverage, and also how to choose the best lot size in terms of risk management. I also took you through how to navigate through the MT5. Once you open the MT5 at the demo account, how do you navigate through? I showed you how to set different types of orders, how to execute orders in the platform, how to put your stop losses, how to put your take profits. Okay, so now this is the advancement, because now you're in a position now to operate the MT5. So therefore, I need now to teach you how to be able to analyze the market so that you can be able now to execute your trades in the MT5. Okay, so this is what we shall be doing in the next maybe 1.5 hours. So we begin by price action. And when we talk about price action, basically this is the movement of an asset price plotted over time. Okay, so it's a graphical representation of the price of an asset. So price action is what enables traders to make trading decisions. So this is because the price action forms the foundation of technical analysis for all financial securities, all assets. So this tells you that if we study probably whatever strategies you're going to study here, you can use the same strategies to analyze maybe stocks, to analyze maybe indices or commodities or whichever financial instrument. Okay, so when you talk about now technical analysis, technical analysis is the study of past price movement to anticipate the future price movement. Okay, so when you look at this chart here, you can see how the price has been moving. So now for me to study this chart, if I start studying this chart to understand how the price has been moving over time, and also helping me to anticipate how the price will move in future, that is now what we are calling technical analysis. Okay, and technical analysis is best done using charting tools, and we have different types of charting tools. Like I showed you on Monday, from the MetaTrader, we have many of them. We have what we call the candlesticks chart. We have the line chart. We have the hollow candles, etc. We have so many of them. So, but for the purpose of this session, basically we'll be looking at candlesticks. Okay, the reason why we'll dwell so much on candlesticks is because candlesticks, they are easier to understand, and 99% of traders use candlesticks because they're easier to understand, coupled with other reasons that you're going to look at, like maybe you're able to use them to identify chart patterns as compared to other types of charts. So from this representation here, or this diagram here, this is just showing you an aspect of technical analysis, how to do technical analysis in terms of trying to appreciate how the price has been moving. So the drawings I've made there, basically I was trying to do what we call the technical analysis. So I was trying to do the technical analysis. So you'll get to understand as we move on. So, and like I said, all these are different types of charts that we have. The main ones are the first three, the line chart, the bar chart, and the candlesticks chart. But like I said, 90% of traders use the candlesticks chart because of some various reasons, okay? And these are the reasons, okay? These are the reasons. So before even you look at the reasons, let's first of all, let me take you through the different types of charts. So number one, we have the line chart. With the line chart, you can see this is just a line. With the line chart, it becomes very impossible for you to be able to follow the price or the movement of the price. The opening and the closing price, you are not able to tell. With the bar chart, yes, you can tell the opening and the closing, but again, now it becomes difficult for you to identify what we call maybe different types of chart patterns. It's not that quite easy. But with the candlesticks charts, it becomes easy, okay? The reason why 90% of traders use the candlesticks chart is, number one, they help determine the current state of the market at a glance, okay? So by the aspect of the color and also the length. Then these candlesticks charts, they also help you identify the market patterns quickly. We always have different types of chart patterns that we usually look in the master class. We did more of that last year. So you can still ask for the recording from your account manager. Okay, you can still ask for the recording from your account manager, and you'll be able to see the different types of chart patterns that we recorded. Okay, so you can ask your account manager to give you the recording that was in the master's class last year. Because last year we used to do the master's class online, but this year we are doing the master's class physically. Okay, so you can ask for that recording because it's still there, and you can be able to learn the different types of chart patterns. So again, candlesticks charts will help you in terms of determining the direction of the market more easily. So, and also the versatility. Versatility meaning that you can be able to use the candlesticks charts from the lower time frame all the way to the higher time frame. Okay, so, and also now the top four, the first four reasons, they will trickle down now to what we call the psychological value. Okay, meaning that as a trader, you'll have a peace of mind when looking at this chart, because now you can be able to determine the current state, you can be able to determine chart patterns, you are able to determine the direction of the market. So there is that peace of mind, which you are calling now the psychological value. So for you to understand the candlesticks chart, this is how the candlesticks chart looks like. So the good thing, we talked about the color, is that you can be able to choose. Because remember in the previous class, we said, or on the Monday's class, the Forex Basics, Forex 101, we said that in Forex trading, you can make money in two ways, either buying or selling, right? So the same way we will have two types of candlesticks, either buy candlesticks or sell candlesticks. Therefore, you can use different colors to denote maybe different types of candlesticks. Like for instance, you can use, like in my case here, I'm using green for buy candlesticks. I'm using red for sell candlesticks. So you can use any color that you feel comfortable with. Okay, so that's up to you. So, but again, the candlesticks, you need to understand the formation or the anatomy of the candlesticks. And like I said, you can either have bullish or bearish candlestick. So this is how the candlesticks forms. So you can see this is the opening price, insinuating that the price may be pushed up all the way to this level to create this high price. Then it retraces back to the opening, so as now to create what we call the upper wick or the upper shadow. Then it went all the way down to this level to create the lowest price, and then it retraced back to close at this particular level, giving us now the lower shadow or the lower wick. But now the range between the opening price and the closing price is what we refer to as the body. Okay, that is what we call the body of the candlesticks. So this is again the two types of candlesticks, the buy and the buy and the sell candlestick. But again, you don't need to cram the opening price and the closing price of a buying candlestick. Okay, you can use the aspect of the color sorts it all. Okay, the aspect of the color sorts everything, right? So the reason why now we will start looking at the different types of trading strategies. And one thing that I always say before even I begin talking about these types of trading strategies is that these are very simple trading strategies, but again, very, very important that you need to understand them, because even before you start looking at those complicated strategies like maybe ICT, like maybe demand and supply, you have to understand these strategies, because everything, all other strategies, most of them are built up from these simple strategies that you're going to look at, okay? They are built from either support and resistance. They are built from either maybe the types of candlesticks patterns, okay? So the reason why understanding this can help you so much as a beginner in terms of even when you'll be seeking higher level of engagement, at least you'll have understood these types of trading strategies, okay? Number one, we begin with the support and resistance. So I'll begin by illustrating support. So when we talk about support, this is an area in the Forex chart where prices drop and fails or struggles to break below. So prices will normally tend to bounce sharply from an area of support, okay? So it indicates traders' willingness to take long position, right? So what you're meaning is that a good example, again, before even I show you, illustrate to you, a good example of support is maybe the floor where you are stepping right now, or the ground, okay? Because it's preventing you from sinking or going on the downside. So that is a support. Where you have placed your laptop on top of the table acts as support, okay? It's preventing your laptop from falling, right? So the same way you'll find in the market, we will have those instances, okay, or those scenarios. So you find that you'll see the market maybe respecting a particular level, okay? You'll see the market maybe respecting a particular level. So this means that this is now what? A level of what? Support, okay? Because this level is preventing the price from going below, okay? So again, this level of support, you need to understand that they are not single prices, but they are what we call levels, okay? They are levels or zones, okay? They are levels or zones, okay? So from this particular point, you can see the first instant the price came and there was a rejection, okay? The price pushed up, so there was that rejection. The second time the price came and there was another rejection, okay? So as a trader, once you see these two types of rejection here, the first rejection here, the second rejection here, what you need to do is now to draw a line and connect these 2 points and then extend, okay? You extend that line, okay? You extend that line. So for me, or for you as a trader, now we want to see the second move here, the third move here, which is very critical. This move is what we use to validate or to confirm a point of support, okay? The third touch. So we don't trade here. This move, when this move is happening, you're just watching the market, okay? If you're trading supports, if you trade support. So here you're just watching the market, waiting for this third touch here. So once we see the rejection of prices from this level, then it means now we'll be looking for our buying opportunities, okay? We'll be looking for our buying opportunities because we say that at support level, it indicates traders' willingness to take long position, okay? So this is the level that you take your buy entries. So if the price retraces back or comes back to this particular level again for the fourth time and we see rejection, then we start looking for our buying opportunities, okay? We start looking for our buying opportunities. So what you're trading here, we are taking this buy, when the market rejects from this particular point of support, you take buys. That is what we call the bounce, okay? That is what we call the bounce. So the price is bouncing off from an area of support. So, but you'll find sometimes the price will tend to go below or break. So what's happening here is what we are calling what? The breakout. So this is the breakout. So when we have the breakout, now we'll be looking for the retest. And then now once we see rejection from this point of breakout, then we'll be looking now for our selling opportunities, okay? So what does that tell you? This tells you that the price will not always respect an area of support. it will reach a time that the support level will be broken out. There will be a breakout. And anytime we have a breakout, there has to be a retest before you take an entry, okay? So if the price breaks below an area of support, then you want to see a retest. And if you see rejection from that level, you do what? You take your sell entries. So this means that this level was support. And now when the support breaks out, it becomes what? When there is a breakout from an area of support, that area becomes resistant, okay? So the reason why, again, you'll hear traders, instead of saying they are trading the breakout, you'll hear traders say they are trading SBR, okay? SBR meaning support becomes resistant, okay? Support becomes resistant. You have to understand these terminologies because you find that some of the experienced traders like using jargon so as to scare. Maybe they want to scare you. They want to show you how vast they had in terms of Forex trading, okay? So SBR should not scare you. This is just another name of breakout of the from a support area, because it basically means support becomes resistant, right? So that's how we are able to trade support. So we can either trade the bounce, okay? So like here, this is the bounce and this is the bounce, or we can trade breakout, okay? So after the breakout, then we wait for a retest, and then now we'll be looking for selling opportunities, okay? Those are the two ways that you're able to trade support. So let's move on, okay? Let's move on. So before we look even at the resistance, this is a typical example or a screenshot from the market about this support, about the support level. And from this instant here, you can see this was the first touch, the second touch, and now we begin engaging the market. This is the level that we now start looking for our buy entries at this level, and also at this level. This is where we look for our buy entries. So this is an area of support. So we move on to now what we call a resistant. Okay, resistant is the brother or is the sister of support. Okay, so resistant is an area in the Forex chart where prices rise, they rise to and fails or struggles to break above. So prices will normally bounce sharply from an area of resistance. Again, an area of resistance, it indicates traders' willingness to take short positions. Okay, it indicates traders' willingness to take short positions. So the same way, I'll try to illustrate an area of resistance. So this is whereby you find, but a typical example of a level of resistance, even before I explain from the Forex perspective, the roof in your house is what acts as a resistance, because anytime you try maybe to go above, you find that when you reach the roof, it will restrict you from going way above, okay? So the roof is an example, a very good example of resistance. So the same way in the market, you'll find that the market will tend to push up, reach a particular level, then there'll be a retracement, okay, or the market will bounce off from that level, then it will come again, then we'll see a rejection from that level, okay, then it comes again the third time. So the first time and the second time, we want to use these points to draw this line and extend it, okay? So that now we will be waiting for the price to come back to this particular level for the third time. And therefore from here now we'll be witnessing what? The rejection. If we see the rejection of prices, now from here we'll be looking to take our sell entries, anticipating the market to sell. So you might find after some time the market will come back to that level, again respect that level. So once you see rejection, we look for our sell entries and anticipate the market to move on the downside, okay? So like we said, this is not just a single price, this is a level, okay? Or it's a zone. It's a zone, okay? It's a zone, because at times you'll find price can throw wicks, maybe even to around that, inside that level. At times it can just reach this level and start selling. So when you're trading these sells, this what you're trading is called the bounce, okay? The price is bouncing from an area of resistance. But again, the price will not keep respecting that level. We will again also have what? A breakout, okay? We will have a breakout from that particular point, okay? We will have a breakout from that particular point. So with the breakout, then we'll be looking for a retest, okay? We'll be looking for a retest. Then now we'll be looking for buying opportunities if we have rejection of prices, okay? We'll be looking for buying opportunities if we have rejection of prices. So what I want to mean is that you can be able to trade against support in two ways: the bounce and the breakout, okay? The bounce and the breakout. Anytime we have a breakout, you have to wait for a retest before you take a trade. So again, the breakout from an area of resistance is what we call RBS, okay? RBS, resistant becomes support. Another name for a breakout from a point of resistance is what we call RBS. Resistant becomes support, okay? So those are the two ways you can be able to trade an area of resistance, okay? Those are the two ways you can be able to trade an area of resistance. So this is an example from the market. You can see it's a very nice area of resistance. The first touch here, the second touch, we extend that line, and now we'll be looking for our entries when the price comes back to this level of resistance. So we can sell here, we can look for sell entries here, and also we can sell at this particular point. Anytime I mention that you need to look for rejection from an area of support or from an area of resistance, or even from the trend line, because next you are going to look at the trend lines, what you used to know that there is rejection is the candlesticks patterns, okay? The reason why I said we are going to look at the candlesticks patterns, because we have rejection candlesticks patterns and we have continuation rejection candlesticks pattern. Rejection candlesticks patterns, we also call them reversal candlesticks patterns, okay? And these are the types of candlesticks pattern, especially the rejection candlesticks. They are the ones that you want to see them form at the point of resistance or a point of support, so that indeed you can validate or you can confirm that the market has respected an area of support or it has respected an area of resistance, okay? I'm using the simplest language possible so that it can become very easy for you to understand or to follow along. So all these key pointers, I have talked about them. I have explained all these key pointers that you need to know about support and resistance as I was explaining. So we said that when the price of an asset or security moves up and retraces, the highest point it reached before it retraces is referred to as resistance. So if the price of an asset moves up, then it retraces, the highest point it reached before retracing is what you're calling resistance. So if the price of an asset moves up, okay, if the price of an asset, when the price of an asset moves down, okay, so this is the movement down now. When it moves down, so the lowest point it reached before moving up. So this is what we are calling an area of support. So you'll find that in the market, the price or the market will keep on creating areas of support and resistance, okay? So the market will keep on creating areas of support and resistance. So again, for those that have been attending my live analysis sessions, the reason why I emphasize looking at or drawing these points of support and resistance from higher time frame, like let's say maybe 4 hour minutes, from maybe 4 hour minutes, from maybe, I mean, not 4 hour minutes, but maybe from the 4 hour time frame. Because again, if you narrow down maybe to the lower time frames, like the 15, 30 minutes, you'll find that your chart will be very dirty in terms of supports and resistance. So I always work with support and resistance in the 4 hour minutes, in the 4 hour chart. That's why I draw them. But now, even if I'm trading on the 15 minutes time frame or 30 minutes time frame or 1 hour time frame, I'll be basing my targets or my point of interest using the support levels in the 4 hour time frame, okay? So you need to note that support and resistance levels are zones and not exact numbers, like we said. So resistant becomes support if the price breaks above it, okay? So this is what we are calling RBS. What I told you is RBS. And support becomes resistant if the price breaks below it, and this is what we call SBR, okay? This is what I told you as SBR. So what you need to know, again, the more times a price test an area of support or resistance, the stronger the level of support and resistance. And also during the breakout, the strength of the wave of the breakout depends on how on the strength of that particular support or resistance. Okay. So what I want to mean is that you might find maybe we have this kind of resistance of support, and also we have maybe this other type of support. So this becomes a strong support because the price really struggled for some time before breaking below it. But this becomes a weak support because we had only 2 times the price retesting this level 2 times, and then there was the breakout. So with this one, we don't anticipate a huge move on the downside. But with a strong support, if there's a breakout from a strong support, then we're anticipating the wave that will follow there will be like a trend. Okay, it will form like a trend. We'll have a old trend on the downtrend. Okay, so those are the key points that you need to note about support and resistance. Then we move now to the trend lines, what we call the trend lines. And basically for the trend lines, these are lines connecting 2 or more points in the same level. Okay, so the difference between the trend lines and the supports and resistance is that the trend lines are diagonal. When I talk about diagonal, so this is diagonal. But when we talk about the supports and resistance, they are vertical or they are horizontal. Okay, so support and resistance are horizontal. So this is support. This is resistance. But now these are trend lines because these are diagonal. So that's what differentiates between support and trend lines. I mean support and resistance and the trend lines. So with the trend lines, we can have 2 types of trend line. We can have what we call an up trend line, and we can have a down trend line. Okay, so how that comes into play is because you understand that we have 3 ways that the market moves. So we have the market can move in an uptrend. Also, the market can move in a downtrend, and the market can move in a sideway. So in an uptrend market, okay, in a trending market, or what we call an uptrend market, we want to see the price create this series of higher highs and higher lows. So this is the lowest point, this is the highest point. So when it retraced here, it created what we call higher low, because this is a low that is higher than the previous low. And then it will create a higher high, meaning this is a high that is higher than the previous high. And then now it will keep on creating those series of higher highs and higher lows. So when you're drawing a trend line from this uptrend line, from this uptrend, so it's the same way that we connect 2 points in a point of support or resistance. So we connect this point and that point, and we extend the line. Okay, so this now becomes our trend line, okay, on the uptrend, which you call it an uptrend trend line. So we will be waiting for the market to come back to this level. So if there is a rejection from that level, then we'll be looking for our buy entries. If we see rejection from that level, we'll be looking for our buy entries. So the market might respect this level for some time. Okay, so taking our buy entries from that particular point. And then at some point, you'll find that we will have what we call the breakout. Okay, so after the breakout, then you'll wait for the retest. And then now we'll be looking for selling opportunities. Okay, we'll be looking for selling opportunities. So it's the same way that you're trading the support, because this trend line in an uptrend, it's a hacked as support, because you can see any time price tries to push on the downside, it bounces off from this particular level. So the same way you are trading support is the same way you need to trade this, only that the difference is that these are trend line because it's slanted. Okay, it's diagonal, right? So even in times of breakout, you have to wait for a retest before now you start looking for selling opportunities. Okay, so when we have a downtrend, this is how the market moves in a downtrend. Okay, this is how the market moves in a downtrend. Okay, it creates what we call, this is the highest point, so it will create the lowest point, then it will create what we call lower high, because this is a high that is lower than the previous high, and then this is the lower low because it's a low that is lower than this, So it will keep on creating series of lower highs and lower lows. So again, we want to connect these 2 points and extend that line. And this becomes our trend line in the downtrend, okay? This is the downtrend trend line. So we'll be looking at some point where the price comes back to that level. If we have rejection of prices, then we'll be looking for our sell entries. Again, if the price rejects from that level, we look for our sell entries. But if there is a breakout, then we'll be waiting for a retest. And then we'll be looking for buying opportunities, okay? So the same way, this one now acts as resistant, because anytime the price tries to push up, this trend line rejects the price from going up. So it's just the normal way. The same way you trade the resistant is the same way we are going to treat also and trade this particular trend line, okay? That is the trend line in the down channel, in the downtrend, okay? So having said that, let me give you some, show you some examples of what you're talking about. So this is just an explanation of how to draw them. I've shown you, I've explained this, that you need to use at least 2 lows or 2 highs to draw a trend line, okay? So it takes the third low or the third high to confirm whether it's valid, okay? Like we did with the support and resistance. So this is a trend line in an uptrend, okay? So this is an uptrend trend line. So you can see we needed this first touch here and the second touch. And now we'll start looking for buying opportunities from these levels that I have shown you with the arrows. And you can see the market pushed all the way on the upside. This is the downtrend trend line. So you can see we needed this first point and the second point, then we draw this line. So these particular points, once you see rejection of prices now, this is where we start engaging with our sell entries, okay? So remember one thing that you need to understand, we are not selling or we are not buying because the price has reached an area of resistance or support. Like I'll use this case here. We are not selling because the price has touched this level. No, we have to be patient and see signs of rejection. Like in this particular scenario here, you can see this is a rejection. So you can see rejection because you can see long upper wicks, meaning that the buyers try to push the price up, but the sellers rejected and they pushed the price on the downside. So these are the rejection that you're trying to look at. Again, you can see the same rejections here. You can see that rejection here. So rejection, you'll see it in form of wicks, okay? So rejection of higher prices, we will have candles with long wicks from above. And rejection of lower prices, we will have candles with long wicks from below. This is the sideway market, so meaning that the market is trading between a point of support and resistance, okay? How we trade this, we don't just sell because the market again is at a point of resistance, or buy because the market is a point of support. So what we want to look at here, we apply the chart pattern idea. So if the market is in an uptrend, okay, if the market is in an uptrend and then it ranges now maybe probably in this particular within a point of support and resistance, let's say that is support, that is resistant. So higher chances according to technical analysis and chart patterns is that the price will break out on the upside, and this will be a continuation of the uptrend, okay? This will be a continuation of this uptrend. So this tells you that it will be risky for you to take sales entries at this point of resistance. So instead, you want only to be looking at buying opportunities from the point of support, because you know the chances are the price will tend to break out on the upside, okay? So if the market is in a downtrend, and then there is consolidation between a point of support and resistance, then with this one, we know that the price will tend to break on the downside. So this will be a continuation of this downtrend. So instead of buying from this point of support, we will only focus on selling at this point of resistance, because we know anytime the price will break out, the chances is that the price will break out on the downside. So since we don't know when the breakout is going to happen, so you can imagine this is now the point that you're trying to enter into the market to buy, if you are maybe probably buying from point of support. So you find that this instant, you'll definitely take a loss. You'll definitely take a loss because the market will break out and continue in the downside, okay? So you always want to ensure that every time you take a trade, you are taking a high probability trade. Because again, you don't want to gamble with your hard-earned money, okay? You don't want to gamble with your money. You want to trade the smart way, okay? You want to trade the smart way. Then we have what we call the channels, and channels are formed when we have two parallel trend lines. The word parallel there is very important. Without that word parallel, it's not, we are not talking about the channel, okay? The word parallel is what makes it to be channel, okay? So parallel means that these are two things that can never meet, okay? For instance, when we have this and then we have that, so these are two parallel lines, okay? But when we have something like this, these are not parallel because at some point they'll meet. So these will give you a different type of chart pattern that we call maybe a wedge, or maybe a peanut, or maybe a triangle, etc. Okay, but when you're talking about parallel, they have to be they have to be parallel. Okay, so we can have two types of channel: the up channel and the down channel. So when you're talking about the up channel, this is how the up channel looks like. So we have those two parallel trend lines, okay, because these are trend lines. So you find that the price will be trading between these two parallel trend lines, okay? It will be trading between these two trend lines, so between this channel. So at this point, if you look at it, even without the trend lines, definitely this shows you that the market is in an uptrend, okay? So when you're trading Forex, number one rule is that your friend, the trend is your friend. So if we're in an up channel or if we're in an uptrend, then we want to concentrate on taking buying positions only because the market is in an uptrend. And where are we taking buying positions? At the point of retracement. So when the market pushes up and retraces, so these are the levels that we are buying. This is what you hear traders saying: we are buying the dips, okay? We are buying the dips. So we are buying the retracements. These are the level, the lower trend line in this channel. These are the levels that you want to be looking for your buys. In case now you witness what? You see rejection of prices from that particular region, okay? So we are not selling here. So if the market reaches here, what I'll do, I'll take my profits and then I'll wait to see the price come back to this particular level. If there is rejection, then I'll buy again, okay? So the reason why we are not buying, we are not selling here is because with an uptrend, the bullishness might be more than the bullishness might be more than the resistant. So I mean the bullishness might persist, and therefore you see the market might tend to break out on the upside, and then there'll be a retest, and then you see the market push on the upside. So the reason why taking a sell here is very risky, because this is an uptrend, okay? So again, we can have a down channel, and a down channel, this is when we have two parallel trend lines on the downside, okay? When we have those two types of trend lines, okay? So the market will be trading between those two particular trend lines, okay? So with this one, this is a downtrend, okay? The market is creating lower lows and lower highs, okay? Series of lower lows and lower highs. So in a down channel or in a downtrend market, we want to be selling only, meaning that now we'll be selling at this point of retracement, okay? These are the levels that we'll be looking for selling opportunities once we see the rejection of prices, okay? Once we see the rejection of prices, right? So those are the only two types of channels. You can have an up channel and a down channel. So this is an example from the market. That is an up channel. So you can see the price moving on this up. So on the lower channel, on the lower trend line here, this is where we want to be looking for our buy entries. In a down channel, the price is in a downtrend, so we want to be looking for our sell entries. In the up trend line here, this is where I've shown you the arrows. This is where we want to be looking for our entries in terms of selling, right? So now I've been talking about rejection of prices. I've been talking about rejection of prices. What do you use to know that the price is rejecting from a particular level? And like I said, we use the candlesticks. Okay, so the reason why the next concept that we need to look at is the candlesticks pattern. Okay, the candlesticks pattern. And you need to understand that candlesticks offer traders with a visual representation of an asset price movement at a glance. You remember the reasons we looked at why 90% of the traders use candlesticks patterns, okay? So they are widely used compared to other charts because they provide much information and in a very simple and easy to understand manner. So when you're using the candlesticks charts, traders basically identify patterns that aid in decision making, okay? So we have many candlesticks pattern, but I have tried to narrow down in what I usually call high probability candlesticks patterns, meaning that these are candlesticks patterns that are easy to understand. They form very often or always, you'll see them always in the charts, and they give very nice entries. Okay, if you are able to understand them, you can be able to get very nice trading entries. And these candlesticks patterns, they're the ones that I've explained, I've highlighted there below, though you're not going to look at all of them, but I'll show you a place whereby you are going to look at these candlesticks patterns and you'll be able to understand them well, and even many more, okay? Many more. I'll show you a place that you can check them out, okay? So when you're talking about these candlesticks pattern, you need to understand that they are what we call, they can be classified into three. The broader classification, number one, single candlesticks patterns, meaning that we only need one candlesticks for us to make a trading decision. We can have two candlesticks pattern, meaning that we need two candles for us to make a trading decision. And we can have three candlesticks pattern, meaning that we need three candles for us to make a trading decision, right? So what are these trading decisions? So you can either make a decision to buy, we can either make a decision to sell, or we can make a decision not to engage the market at all. So those are the three decisions that you can be able to make: either to buy, or to sell, or not to engage the market at all, not to take any position at all, not to trade, okay? Again, what will guide you in terms of knowing whether you are going to make a sell or whether you are going to make a buy or whether not to trade again, we can classify this candlesticks pattern in terms of reversal candlesticks pattern, reversal or rejection candlesticks pattern. We can also classify them in terms of continuation candlesticks pattern, meaning that they are showing continuation. And again, we can have indecision candlesticks patterns, okay? So we begin now with the dojis, okay? We begin with the doji. And when we talk about the doji, you need to understand that dojis, they help us to show or to know how bears and bulls are engaged in a tug of war. You remember on Monday we talked about this tug of war, that every currency in a pair wants to dominate. So there'll be that contention because each and every currency wants to dominate, okay? So, and now this is where you find that now the dojis tend to form the most. So we have four types of dojis. We have the normal doji, the long-legged doji, the gravestone doji, and what we call the dragonfly doji. So we begin with the normal doji. And with the normal doji, basically, this is how a normal doji looks like. Okay, this is how a normal doji looks like. So it looks like a plus sign, okay? Meaning that the opening price and the closing price are equal, and the upper wick and the lower wick are equal. So it's more of a plus sign. So this type of candlestick shows that buyers and sellers are equal. So if buyers and sellers are equal, then this signifies indecision, that we don't need to either buy, or sell. So we just need to wait and we see what will happen next. Maybe there will be another candlestick pattern that will now give us an informed decision to be able to sell, okay, or to buy. So we don't engage the market when we see a normal doji. It's an indecision candlestick. So you can see this is it here. I have tried to circle it here, and you can see what is basically happening here is consolidation. There is not much movement. This is just consolidation because it shows or it signifies indecision. Okay. So the other type of candlestick that is important for you to understand is the long-legged doji. So the long-legged doji, this is how it looks like. Like the name suggests, it has long upper wick and long lower wick. But again, the opening price and the closing price are equal. So again, this type of candlestick is an indecision candlestick pattern. Once we see it in the market, we don't trade. Okay, we don't trade. We have to wait and we see the type of candlestick that will happen maybe in the next maybe pattern that is going to happen. Okay, so with this type of candlestick, what becomes interesting here is now the long upper wicks and the long lower wicks, because this now tries to show that volatility is trying to come into place. Okay, and these types of candlestick, basically you'll see them especially when we have mixed data. Okay, you have heard me talking about data. Those have been following me for some time. We have mixed data. And when you have mixed data, you find that the market will definitely tend to react on both sides. So you'll now, during that time is when you'll see these types of wicks, the long-legged doji, okay, because there is volatility. So the buyers try to push up, sellers try to push down, but at the end of the day, buyers and sellers were equal. So it is created indecision, okay, indecision, not to engage in the market at all. Okay, not to engage in the market at all. And you can see, once it happens, you can see it here. Also, what happens here is basically consolidation. Okay, so meaning that indeed it's not the best time to engage the market when you see that type of a candle. Okay, so we move on now. The gravestone doji, this is a reversal or a rejection candlestick pattern. So this is how it looks like. Okay, this is how it looks like. Okay, this is how it looks like. Forgive my drawing, but this is how it looks like. So we can have no lower wick at all, or you can have a small lower wick. But what makes them to be gravestone doji is these long upper wicks. Okay, so these long upper wicks, they show rejection of higher prices, that the buyers wanted to push the market up, but sellers came into place and pushed the market on the downside. So this tells you we'll be having an uptrend, and when the market reaches maybe a point of resistance or in a downtrend trend line, then these are the types of candlesticks that you want to see, the gravestone doji, for you now to sell the market. Okay, for you to identify that there's a rejection, and then now you'll be looking to sell the market, and then we'll see the market move on the downside. The reason we are calling them their bear signal or bearish signal, or what we call sell signals, and also they show reversal or change in direction, because you can see we are in an uptrend. When they formed, the market reversed and pushed on the downtrend. Okay, so these are what we call gravestone doji. We said it can happen maybe this type when we don't have lower wick at the bottom, and when we have maybe a slight wick at the bottom. But what makes them interesting is the long upper wick, which shows rejection of higher prices. Okay, the reason why it will form at a point of resistance or in a downtrend trend line. Like you can see in this case, this is the candle, and you can see once it formed, the market pushed on the downside. There was the selling. So the market here was in an uptrend. Once it formed, there was the reversal, and the market began to move in the lower direction or in the opposite direction, that is in the selling direction, right? So we have dragonfly, and again, this is the opposite of gravestone. So dragonfly, we have rejection of lower prices. So this is how the dragonfly looks like. Okay, so we can have no wick at the top, or we can have a slight wick at the top. So still this makes it to be a dragonfly, because the interesting part is these lower long wicks, meaning that the market was in a downtrend. Sellers tried to push the price on the downside, but buyers came and pushed the price up. The reason why we are saying rejection of lower prices. So they'll definitely form at a point of resistance or in an uptrend trend line. And therefore, once they form, they are buy signals. So we look to buy the market. Okay, we look to buy the market, and then we will anticipate the market to reverse and go in the buy direction. So the reason why we are calling them, they are bullish signals. They indicate reversal, that is the change of direction from downtrend to uptrend, and they indicate rejection of lower prices, the virtue that they have long lower wicks, meaning that the sellers try to push the price on the downside, but buyers came in and pushed the price on the upside. Okay, so this is it. And then you can see the price was in a downtrend, and now the price tried to started moving in the upside. Only that I did not cover a wide area to show you the price action around that particular point. Right? I believe you are together. So the next types of candlesticks patterns that you're going to look at are the pin bars, and the pin bars, they also fall under the category of reversal or rejection candlesticks patterns. Okay, so if you don't find the dojis, that is maybe the dragonfly and the gravestone, then you want to look at you want to see the pin bars. That is the bearish pin bar and the bullish pin bar. Okay, so those are another types of candlesticks patterns that show rejection, and also the inverted hammer and the hanging man. Okay, but for this webinar, we are going to look at the first two because they are easy to understand. They form very often, so it's good for you to understand them. So when we talk about the bearish pin bar, or what we call a shooting star, they form at point of resistance. Okay, they form at point of resistance. And before even I explain how they form, this is how they look like. Okay, this is a bearish pin bar. Okay, we have long wicks at the top, and then we have a small body. Okay, you can see the small body. We have a small body. So the difference between this and the gravestone doji is that the gravestone doji, the buyers and the opening price and the closing price are equal. But now with this one, the opening price and the closing price are not equal. And the reason now you can see the body of that candlestick. We have a small body. Okay. Also, we can have it in this manner. You can have it in this form, a small body, and then we'll have a small wick at the bottom. But what makes them interesting, bearish pin bar, is the fact that we have these long wicks from the top. Okay. So again, these candles will form at a point of resistance or in a downtrend trend line. Okay. In a downtrend trend line. So this means that the market will be in an uptrend. So once it reaches a point of resistance or a point of this downtrend trend line, then you see these types of candlesticks form. Then we want to take our sell entries, and then we'll be anticipating a reversal, meaning that the market now will be selling. Okay. Sorry. So the reason we are saying that they indicate reversal, they are sell signals, and they indicate rejection of higher prices, meaning that the buyers tried to push the market up, but the sellers came in and pushed the market on the downside. Okay. Sorry. So that is what that is how we use these types of bearish pin bar. But what you need to note is that if a bearish pin bar maybe closes as a bearish pin bar in that manner, but remember now you said about the type of the candle, the color of the candle. So if this shows you that maybe I don't know. So if this closes as a buy candle, but in form of this bearish pin bar, so it means that we still have some buyers in control of the market. So we have to wait for the next candlestick to close as a sell candlestick so that we can sell. Okay, so if this closes as a buy candle, we have to wait for the next candle to close as a sell candlestick so that now we can sell from that particular point. But if it closes as a sell candle, like in this particular case, it closes as a sell candle, then we need to sell immediately. Okay, we need to sell immediately because already sellers are in control of the market. Okay, so that's how we trade these bearish pin bars. Okay, so for the recording, you can always get the recording from your account manager. Okay, so if you don't have an account manager, You have to sign up for an account so that you can access the recording. If you don't have an assigned account manager, go to www.scopemarkets.co.ke. I've shared the link. Go there, sign up, and then you'll be assigned an account manager, and then the account manager will be able to give you the recordings. Okay, it's as simple as that. It's as simple as that. That's how you access the recordings. So this is an example of a bearish pin bar from the market, how you're able to trade it. So you can see this is the pattern here, the bearish pin bar. So you can see the moment it formed, then the market now started selling. Okay, the market started selling. So we sold immediately because it closed as a sell candle, meaning that already sellers are in control of the market. So you can see the market selling, right? Then we have the bullish pin bar. Okay, we have the bullish pin bar. And with the bullish pin bar is the opposite of the bearish pin bar. So this is how the bullish pin bar looks like, okay? This is how the bullish pin bar looks like. So we have long lower wicks and the small body. Or we can have this small body, a small upper wick, and then long lower wick. So these long lower wicks again signify rejection of lower prices, that the sellers wanted to take the market all the way down, but buyers came in and started pushing the price up. So the reason we are saying that these types of candlesticks, they form at an area of support or in an uptrend trend line. Okay, so once they form, now we'd be looking for our buy entries, anticipating the market to reverse and go in the buy direction. And the reason we are calling them buy signals, okay, the reason we are referring to these types of candlesticks, that they are buy signals, and also they are rejection candlesticks because they are showing rejection of lower prices, or reversal candlesticks because we were in a downtrend. Once they form, now we are anticipating a reversal to the uptrend, okay, reversal to the uptrend. So again, another question also here with this one, if we have this bullish pin bar close as a sell candle, if this closes as a sell candle, you have to wait for the next candle to close as a buy candle for us now to buy, okay, for us now to take a buy position. So the reason why we have to wait for that is to confirm that indeed buyers are in control of the market. Because if it does not, this next candle does not close as a buy candle, then the pattern is invalid, okay? The pattern is invalid. You don't trade it, it's invalid, okay? So we have to wait. We have to be sure that indeed buyers are in control of the market, okay? So, but if it closes as a buy candle, maybe like in this particular case, then we will buy immediately, okay? We'll be looking for our buy entries immediately, right? So this is how it forms. So you can see in this particular case, this is the type of the candle here. You can see the bullish pin bar. So it closed as a buy candle. So what it happens now, we start doing what? Buying immediately. We buy the market immediately, and you can see the market bought and is still pushing all the way up to this particular point. Okay. So that's how you trade this bullish pin bar. They are not complicated. They are not complicated. Again, you find that for people who trade maybe order blocks or maybe the supply and demand, you find that this area, okay, this area can give you a very nice entry based on this candle here. So meaning that this area can give you a very nice entry again here for a buy based on the order blocks or based on maybe the supply, the demand strategy, okay? So the reason why I said these strategies are very, very simple, but yet you have to understand them before even you start going for advanced concepts like supply and demand, ICT, I don't know, smart money concepts, etc., etc. This has to sink in your mind first before you now start trying to go into that other direction. So the key pointers to note here is that, or the characteristics of pin bars is that, number one, like I've said, they must have long wicks. So if it's the bearish pin bar, they must have long wicks from above. If they're bullish pin bar, they must have long wicks from below. Then the other characteristic number 2 is that the body should form towards the end of the candle and not in the middle, okay? So they can form either towards the end or at the end. Like for instance, with this is the body forming at the end. This other one is the body forming towards the head, okay? The body forming towards the head, but we have to have these long lower wicks. Then we have a small wick here. So if we have this type of pattern, body forming in the middle, this is not a pin bar, okay? This is not a pin bar. So like I've always also emphasized is that if you have a bullish pin bar closing as a sell candle, you have to wait for the next candle to close as a bullish candle to confirm entry. And if you have a bearish pin bar closing as a buy candle, you have to wait for the next candle to close as a bullish candle to confirm entry, okay? To confirm entry, right? So now we look at the last bit, that is the bearish engulfing and the bullish engulfing. Then from here, we'll jump into the charts. We try to look at various examples in the charts. So, and when you're talking about bearish engulfing and maybe bullish engulfing, first of all, you need to understand the meaning of engulfing. So engulfing means overshadowing. Another name for engulfing, it's overshadowing, right? It's overshadowing. So when we have a bearish engulfing, this is a two candlesticks pattern. So we need two candle to form this type of pattern. So this is how it looks like, okay? This is how it looks like. So we want to see the first candle, which should be, the first candle should be a buy candle, okay? This is a buy candle. I'll write B there to signify buy candle. And then the next candle should be a candle that engulfs the first candle. So it should be bigger than the first candle. And this must be a sell candle, okay? It must be a sell candlestick, okay? So if you have a small candlestick here, and then we have a big sell candlestick that engulfs the buy candlestick, what does that give you? It gives you an idea that sellers are trying to overcome buyers, okay? So definitely this now is what we call what? A sell signal, okay? A bearish engulfing, it's a sell signal. So how you trade this, you want to mark from the top of this pattern the highest level where the wick reached, okay? So let's say the first candle there at the highest wick, and at the bottom you want to mark up to the body of the first candle, okay? So you want to mark it in that manner. So this region, it's what now we are calling what? This region is what we are calling the sell zone, or what we call bearish order block, okay? Other people will call it a bearish order block, okay? That is minus OB, bearish order block. Or also, other people will call this a supply zone, okay? A supply zone. So we want to see maybe probably the price can push back to that level. And from this level, now we want to take our sell entries, okay? Sorry, so from this level is whereby we start taking our sell entries, right? So this means that the market was in a downtrend, okay? The market is in a downtrend, and once we see this type of bearish engulfing, they will signify reversal, okay? They will signify reversal. So if now we sell from this point and the market continues to sell, so meaning that now we're in a downtrend, and in the middle of a downtrend, then we find another bearish engulfing. Okay, in the middle of the downtrend, we find another bullish engulfing. And let's say maybe this time round, the second candle has the longest wick. So we mark from the longest wick and then up to the body of the first candle. And then we wait for the price to come back to this level, and then we sell, okay? And then we look, we sell, right? So this creates, again, another supply level, an order block, and maybe a selling zone, okay? So at this particular point, this is a continuation. So this bearish engulfing pattern, they can be reversal candlesticks pattern, like in this particular case here, and they can also be continuation candlesticks pattern, okay? Meaning that they will show continuation of the selling pressure, okay? So this one here is the continuation. Here it's the reversal, all right? Then now, This is how, what I've been explaining, how we take trades now using the bearish engulfing. So you see, this is the pattern here. We have the buy candle and we have a long sell candle that engulfs the buy candle. We mark up to the top of the wick of the longest candle that has the longest wick and up to the body of the first candlestick. And then now we wait for the price to come back to this selling zone, because this will be our selling zone. And then we take our sells from that region and you can see the price dropped. Okay, you can see the price sold, right? Then we have bullish engulfing, the opposite of bearish engulfing. Very interesting. So how does the bullish engulfing look like? This is how it looks like. We want to have the first candle being a sell candle. Okay, the first candle being a sell candlestick, and the second candle being a buy candlestick that engulfs the sell candle. Okay, this is a buy candlestick that engulfs the sell candle. So again, with this notion, what gives you is the bullishness. That bullishness is trying to come in place because you can see the buyers are overcoming the sellers, right? So with this, from the top, you mark up to the top of the body of the first candle, and at the bottom you consider up to the lowest wick. So this is what becomes our buy zone or our bullish order block. Others might call it bullish order block, or what we call the demand zone. Okay, the demand zone. So we want to see the price come back to this level, and then we start buying. We look for our buy entries at this particular level. So if the price is on the downtrend and it forms a bullish engulfing, then this signifies to us rejection, okay, or reversal. I mean reversal. So here, this type of pattern will be a reversal bullish engulfing pattern. So if we buy now, it means that we are in an uptrend. And in the middle of the trend or somewhere in the uptrend, you find another bullish engulfing, okay? So again, we mark to the wick and to the body of the first candle, and then we see the price coming back to this level, and now we buy, anticipating the price to go up. So here it's rejection or reversal. Here it's continuation, right? So these are buy signals. They give us an indication that the market is going to buy. So this is it in the chart here, represented in the chart very clearly. So this is the bullish engulfing. You can see here the sell candlestick and the big buy candle that engulfs this buy candlestick. We mark that region, the price, we wait for the price to come back to this particular level, and then we start buying the market. Okay, we start buying the market. If you look keenly along here, we have another bullish engulfing. Okay, at that point, only that my drawings are not that clear, but if you look at it clearly, this one, these two candlesticks form what we call a bullish engulfing. So you mark to the body and to the bottom. So you can see the price came back to this level, and then the price continued to push up. So this pattern here, it's a reversal, and here it's a continuation pattern. Okay. So again, if you look clearly at this level, you have a bearish engulfing. So if you mark well to the body of the first candle and to the top, you consider the wick. If no wick, we consider the bodies. So you can see the price came back here, and now you can explain the reason why the price is reversing, because of this bearish engulfing. So if you're in your buy from this level, or maybe even in this level, so once you see this type of pattern here, it means that now you need to take your profits, because the market is doing what? It's reversing. So you take your profits, and maybe if you have not attained your daily targets, now you can trade what? The bearish engulfing. If you have attained your daily targets, then you can just watch it, or you can place it in demo account. Remember, discipline, it's another key aspect of Forex trading, okay? It's another key aspect of Forex trading. We shall talk about that when time is due, right? So now what I want us to do, I want us to go to the charts. So give me 1 minute, I share my chart. So I want us to go to the charts. Give me a few minutes. What did I do? Okay, not that one. So that is the chart, that is the Forex chart, right? The trading view. So from this chart, we want to look at very common regions. Okay, number one, what can we be able to see? Of course, automatically you can be able to see a trend line, right? So a trend line, when you're drawing trend lines, we want to draw them with the most number of touches, okay, with the most number of touches. So we have the first touch, the second touch. So we begin buying from, once you see this rejection from the third touch here, so you could have bought here. Also, you could have taken a buy entry at this particular point. Okay, you could have taken a buy entry at this particular point, right? So again, you can see when I'm doing this, I have not considered this this one, and I've not considered this one, because if I drew it from these 2 points, then this will not give me most number of touches. Okay, it will not give me most number of touches. So this below this is what gives me the most number of touches. Okay, so you have to consider again the one that gives you the most number of touches, or the more number of touches, right? So again, from this particular level, when we come, let's even begin from the 4-hour time frame, because we said we identify the point of support and resistance using the 4-hour time frame. So you can be able to see clearly from the 4-hour time frame, this is an area of what? Resistant. Okay, again, considering the most number of touches, the first touch, the second touch, then the third touch. So we could have sold the market once we saw this rejection, and you can see the market pushed all the way down to this particular level. Okay, and where it reached, it actually reached an area of what? An area of resistance. Okay, an area of resistance, an area of support, right? Because this is the first touch, the second touch, the fourth touch, and this was the fifth touch. So again, this is an area of support. Okay, this is an area of support, right? Again, now from this particular point, you can be able to see very nice engulfing. Okay, very nice engulfing pattern. So we have a bearish engulfing pattern here. This is a bearish engulfing pattern. So you can see the price pushed on the downside, but the price came again to this level, and this now could have given you a very nice selling opportunity. Okay, so if you'll be selling at this particular point, your first area of interest, you want to target these lows here, the immediate lows. You can see they were taken out. Okay, they were taken out because you can see after the price pushing out, the price came and took these lows out. And the next level now is this area of support, and you can see the market reached at this level. So your target was achieved, right? Your target was achieved. So what is the risk to reward ratio there? That's your entry, and this is your target. Where do you put your stop loss? Slightly, I mean, this is your entry. So you put your stop loss slightly above this zone. Okay, so you can have your stop loss even if you have it slightly above this high point there. That is a risk to reward ratio of 1:5. Okay, very, very nice risk to reward ratio. Okay, so again, if we look very well again, you'll find that let's look very keenly. Let's look very keenly. So you'll find that, let me delete this. So you find that at this particular level, we have another bearish engulfing. Okay, we have another bearish engulfing. So these are bearish engulfing. This candle and this candle creates a bearish engulfing. The price came, activated this level, and you can see the move on the downside, okay? The move on the downside. So what I want to emphasize is if this is the best level to trade, when this zone is very fresh, so you can see it give you like 145 pips. When it comes to this second touch here, this is not high probability. There are chances that this becomes 50-50. There are chances that the price can go up, or the price maybe, there are 50 chances that the price can go up and the price can go down. Because when you're trading these levels, especially the engulfing, because it will create an area of supply, like the bearish engulfing will give you an area of supply, you want to consider the first retest when the zone is very fresh. So like when the price came here, this was not advisable to trade, okay? This was not advisable to do what? It was not advisable to trade at that particular level. Also, even in this instant, because I traded this part here when the price was the very fresh zone, then this is not a nice tradable opportunity, okay? So I let that one go, okay? I don't trade that particular type of pattern, okay? I don't trade that particular type of pattern. So we move on the downside, okay? On the downside, we have this particular level. So this is still yet to be tested. This is a buy zone or a demand zone. You can see the engulfing, okay? You can see the engulfing there. So let me delete these so many lines here. So let me delete that. So you can see this. So this is an untested area. It's very fresh. So there are higher chances. You never know. There are chances. We don't know, but gold at some point reached this particular level, 1986. I'm not saying today, tomorrow. I don't know when. So mine is to mark the region and patiently wait until when the price will reach to this level so that I can be looking for my buy entries, okay? So that I can be looking for my buy entries, because this one gives us a bearish engulfing, okay? It gives us what we call a bearish engulfing. You can see it there, the bearish engulfing, you can see it here, okay? So, I mean a bullish engulfing, not a bearish engulfing. This is bullish engulfing, sell candle and a big buy candle. So, I had seen these two. This is a bullish engulfing. Okay, these are bullish engulfing. Sell candle and a big buy candle. So the price came back to that particular level, and you can see the price pushed all the way up. Okay, the price pushed all the way up, right? What made the price to come here? This engulfing, this bearish engulfing. We had this sell candle and this big sell candle. The price came back here, and then now we could be selling from this level all the way, targeting the first target, these lows, and you can see the price came all the way to this particular level. So from this, targeting these lows there, that's around 147 pips, where the price reached around 264 pips, okay? So you can see how profitable these levels are, okay? You can see how profitable these types of candlesticks pattern are. When you're talking about the pin bar, okay, when you're talking about the pin bar, this is a bearish pin bar. So if you have the bearish pin bar here, closing as a sell candle, then you take your sell from this particular point, and you can see the market pushed almost 204 pips, okay? It pushed almost 204 pips, right? If we backtest on the backwards, we move again below these points here. So you can see the bullish pin bar. The bullish pin bar, we have two of them. This one, also this is a bullish pin bar. So this shows you immediately this one closed. Then it shows you what? That now you need to enter a buy entry, and you can see the price pushed all the way to this particular level. Why is it forming? At an area of resistance and at an area of support, the one that you have identified here, the area of support, okay? At this level, I can see a very nice uptrend, okay? I can see a very nice trend line, okay? So first touch, second touch, that touch, and you can see the price kept on pushing up. Okay, the price kept on pushing up. Here there was the rejection, or there was the breakout, and then the retest, and also it gave another retest, but eventually it did what? It is sold. Okay, the reason why the price did this second retest, it was because there was a demand level here, a supply level here, which is created by this bearish engulfing, and the price came to this level and sold. Okay, the price came to this level, and you can see how the price sold. Okay, you can see how the price sold, right? So what you need to do now, I just gave you the knowledge. So whether you're going to apply the knowledge or how you're going to apply the knowledge basically lies on your side. That is, you need to go, if you want to succeed in this, you need to backtest. Backtesting is looking at the previous market conditions and try to identify instances when these particular patterns happened. Okay, and then once you do that, you be journaling or you be keeping these flashcards. Okay, like when you mark here, you can just save that as a flashcard. How do you save? You come here, you can see where we have the camera, then you copy as an image, or because you want to save, maybe you can open, like for me, what I do right now, the WhatsApp gives us an opportunity to be able to chat with yourself. Okay, so you can, what I do now is that any important information that I want to remember or that I know I refer to it in the future, I WhatsApp myself. Okay, so I just copy image, or copy link, and then I post my WhatsApp number. Or I can download as an image and save it in my desktop. I'll open a folder and call it flashcards. Okay, so meaning that I'll be looking, even when I'm trading live, when I'm trading the market live, trying to look for entries, if I'm not sure whether this is an entry, then I'll refer to my flashcards and I'll be able to confirm that indeed, when the market happens in this particular manner, it is sells. Okay, so therefore it will increase my confidence in terms of taking that particular sell. Okay, so that's what you need to do as a beginner if you want to see this information being helpful, because you might attend even 20, 30, 40 webinars in this class and you still don't get the concept. If you don't backtest, you'll not still understand that concept. Okay, so you have to backtest. Lazima ujitume kama trader, because you want to get the concept right. So you have to backtest. Okay, so that is the assignment that I'll give you, but I'll not ask you to submit the assignment. But I believe that you'll take that initiative, you'll backtest. If you have any questions, always ensure to join me in the live analysis from Monday all the way to Thursday, and ask any question pertaining whatever you are learning in this class, in these webinars. Ask me any question during those sessions, because those are the sessions that we try to answer difficult questions maybe, or probably as I analyze maybe the market with you, because I again use these strategies to analyze different of them, the ones that I'm going to teach you here. And from there, maybe now the concept will sink in. But what matters, 90% of you succeeding is by backtesting. Okay, it's by backtesting. Kujituma, lazima ujitume, right? So also in that live analysis class, it will help you in terms of getting very nice entries, because you analyze the market, we look at the probable entries that we're anticipating. And then again, the fact that we have a trading competition. Okay, we have a trading competition. I know you know that. If you don't know, we have a trading competition whereby every week we are giving away 50,000 Kenya shillings in form of trading credit. So it will be credited in your trading account. Every week we have a draw, but the competition began on 1st February, going all the way to 5th February, I mean to 5th March. So that means at the end of the competition, we'll have 3 winners. The first winner taking 120,000 Kenya shillings and some merchandise. Number 2 taking home 75,000 Kenya shillings with some merchandise. Number 3 taking home Kenya shillings 50,000 plus some merchandise. Okay. So how to participate in that contest is to create an account, a live account at Scope Markets. So you go to www.scopemarkets. I can share the website again, www.scopemarket.co.ke. Or maybe someone maybe probably, let me see if we have someone here. I don't know if you have even someone from Scope Markets in this class who can share the link. Okay. I don't know if you have a staff. If you have a staff here, maybe probably they can share the direct link. But even without the direct link, you go to www.scopemarket.co.ke, you sign up and create a live account. So once you create a live account, you fund a minimum of 10,000 Kenya shillings. That's what qualifies you to participate in the contest. A minimum of 10,000 Kenya shillings. That's very minimal. It will become around $80 around there. So then before you start trading, ensure you register to enter the trading competition using that link. Okay, I shared the link. You click that link, you register for the trading. Now you'll be in the trading competition. So another qualification is that now you need to grow your capital consistently. You need to grow your capital. So we will be looking at maybe when you're doing the weekly draws, within this week, who has been able to grow his capital the most, and that will be the person who will go away with the 50,000 Kenya shillings trading capital. At the end of the competition, we'll be looking at who has been able to grow his capital the most, beginning from the 1st all the way to the 5th of March, the 1st of February all the way to the 5th of March. And the first top 3, those are the ones that are going to get that particular reward. I said number 1, 120,000 Kenya shillings plus some merchandise. Number 2, 75,000 Kenya shillings plus some merchandise. Number 3, 50,000 Kenya shillings plus some merchandise. Okay, that's interesting. And again, like I said, you can always join me. Those that have always joined me in the live analysis, they can attest that the entries we get there, the analysis that we do there is very much helpful. Even if we will not be able to get an entry during that particular moment, but I tell you the regions that we are going to mark, the areas that we are going to mark, if you wait for the price in those levels, they'll definitely give you entries, okay? And you can find yourself even growing and winning this amount of money from these live analysis classes, okay? So that is from me, not unless there is any question. So we can end it at that particular point. It's already 1. Do we have any questions? Any clarifications? Okay, so the silence means no question, no clarification. So then let's meet again on tomorrow during the live analysis class, 10 a.m. to 11 a.m. And then tomorrow we'll be having the physical masterclass, okay? So the physical masterclass will happen here in our premises. That is, we are located in the Lower Kabete Road, Westlands, Lower Kabete Road, West Side Towers, 4th floor. If you come there, you'll meet us there. And I will emphasize, if you are around, just come, because during this class again, we look at different types of I mean the concept that maybe probably you as a trader, you've been trading, you've been encountering problems. So it's more of a clinic, in short, trying to iron out those issues that have been maybe probably disturbing you as a trader. And again, when we get entries as well in that class, it's also come live trading, okay? It's a masterclass, come live trading, right? Clinic, come live trading, right? So that's it from me. The tomorrow's masterclass will happen physically at 5 a.m. to 5 p.m. to 6 p.m. Okay, 5 p.m. to 6 p.m. So ensure that if you're around, you can take advantage of that. Just come, let's interact. Let's also get to know each other, because again, as a trader, you want to build a community of traders. Like maybe you don't want to go alone. You want to have a friend who trades Forex. And how will you get to know those people who trade Forex if you're not interacting with them? So you have to come and interact. and create networks. Okay, it might not only be in Forex. Maybe you never know, the person you'll be talking to can open other doors. Okay, so just come if you're available. Okay, so thank you so much and have yourself a wonderful afternoon.